do you have any advice for a novice investor? How do I look at a company and evaluate them? Can I see like, what kind of ratios am I looking at?
Yeah, I think this is kind of interesting. I have seen over the years and talking to different people, I get asked questions about, what should I do and what have you. And then I ask them what they are doing. And it's kind of amazing to me. I mean, there's some people doing some really aggressive things. I mean, really aggressive. And they've been investing for 3 months or 6 months. And I don't know. I'm sure that there are lots of stories where it works. But just personally, it's really difficult. I've been doing this for 36 years, 35 years now, just professionally, and then I was obviously an investor before I became licensed. And one of the things that I've learned over the years is that it's incredibly complex, and it's super hard to learn. And it's sort of like, hey, I wake up one day and I'm going to play baseball, right? So you go from deciding to play baseball. I'm a novice at that thought to playing in the professional leagues, trying to hit 100 mile an hour fastball and 96 mile an hour sliders and what have you, right? And that's what I see people doing. The novices are just going for it. And again, in the right market, you look like a genius. In 2020, when things were flying, it was difficult to lose money in that kind of market. You just throw stuff out there. It was really, really hot. That's not the market that we have now, and it's not normally the market we have anyway. So a novice, in my opinion, should have a pretty good amount of their money right in the big old indexes. The S&P 500, like the Vanguard S&P 500 VOO is the symbol for the ETF, or the Vanguard Total Stock Market Index, which is VTI, right? So that should be where most of the money goes. But the question was about individual stocks and what you look for in those individual stocks. And I guess my first thought would be keep that portion of your portfolio smaller than if you're a novice, than the bigger portion of the portfolio. I mean, even for us, I mean, we have only a few individual stocks that we have in our portfolio at any point in time, and most of the money's in the overall markets just because it is so difficult to get the right stocks. Now, what I look for personally has a lot to do with cash flow. So price, what they call price to cash flow, that's a big one for me, especially in this market right now. Maybe not as important in 2020. Again, you could kind of throw some of these out the window in certain markets because nobody's paying attention to price to cash flow in 2020. They were just looking at the innovative possibilities of that company, and that was what people were buying. And so you have to change your methodology sometimes. Right now, earnings, so price to earnings, sales, price to sales, and price to cash flow. That's what I'm looking at right now, are those particular areas. And then I guess the last thing is just cash on hand, right, versus debt in total. So you'd like to have companies that have great name recognition, relatively low debt compared to their cash on hand, great cash flow, good PE ratios, at least reasonable, and what have you. So I think that's what's going to lead us out of this. And so that's that's where the Nvidias are, the Apples are, the Microsofts are, even the JP Morgans and some of these, big names that are out there, the Home Depots, even Target, which is, got pounded. Still really a great name, has great everything, missed some earnings, and they got hit for that. But, Starbucks, which is growing like wildfire actually and doing quite well, stock is still down a bunch. So I like that, right? Right now, I think this is sort of a bottom picking market in the really good names. And I'm sticking with things that I think, almost everybody would recognize, to be honest. And it's, more for my own portfolio than for my clients. But I'd be cautious here not to get too carried away with really speculative things, just because we're in a market that could fall another 10, 15, 20% for all we know. We don't know, like you said, whether this is a recovery or not.
Yeah. And if you're investing in individual stocks, sometimes it's a long game. You're not going to get a return for maybe 2-3 years or even 5 years. And so you have to pick something that you're really kind of trusting. If you don't believe in this company, should you be investing in it?
That's a good point. So my own portfolio personally, outside of my broad market exposure, I have a list of about 20 stocks that I'm invested in, and that's exactly it. Every time I look at it, I think to myself, if that drops, do I want to buy more? Do I believe in it? When I look at it and I look at the cash flow, I look at the name, I look at the earnings, price ratios, all those things, you have to believe in that stock. And that eliminates a lot of stocks for me, because there are certain times where you can do speculative play, that are some great things that are out there. But when I'm looking at individual stocks right now, I have to really believe that company is going to be significantly higher in price than the market might be in 5 years, let's say. Maybe it's low, but outdid the market 5 years from now. Maybe it's way higher. So who knows? But, so Home Depot, let's say, just for example, I look at Home Depot, I think to myself, okay, whatever's happening right now with the price, will Home Depot be able to outperform the market going forward? I think so, right? Might not be true, but I believe that. And so when it drops and I want to, rebalance my portfolio, I'm going to buy some more Home Depot. They're high conviction companies, NVIDIA, all that kind of thing. So anyway, that's a good point.
Yeah, and if you feel like instead of a company, you believe in a trend, you can try and look for an ETF that meets that trend.
Yeah.
So if you really believe in electric cars and autonomous driving,
Right.
you can find an ETF for that. And so you could target based on your belief systems and what you have conviction in. That way you can stay in the market.
Yeah, I'm doing the same thing, actually. So I look at that and I say to myself, okay, will that category be bigger in 5 years? And so there's a ETF that iShares called iDrive, IDRV, that I have. Cloud computing is another one I think will be bigger in 5 years. Clean energy, I like, for a 5-year run here. And, just trying to accumulate healthcare, I like at this levels, 5 years from now. And so, you're exactly right. You can buy an ETF that's kind of buying the entire ecosystem of that particular category. And cybersecurity is another one that I have too. So you can kind of combine. You got my portfolios. I've got this broad index pieces, and I've got these kind of targeted ETFs like cloud computing, and then I have some individual stocks that I really believe in. Right. So that again, that's just my outlook on it. I think there's some opportunities here in this particular downturn to try to accumulate some of those. And I've been very happy, at least in the up days, that my portfolio has outperformed the market. So I'm hopeful that if the market does recovery, my portfolio will outperform the market during that recovery period. So we'll see what happens.
Yeah, but you have to remember when you're introducing these individual stocks, you're going to add volatility.
Yeah.
And so your up days could be worse.
Yeah.
They could be better, but you're not going to be as close to the market. And so you're going to have to be able to stomach that kind of movement.
Yeah, exactly. Most likely you'll fall more on the down days because, what you're really doing is just adding beta, what they call beta, which is just volatility versus the market. And so, again, that can be a bad thing. You have to be very careful when the market's coming down, because you're actually adding more volatility, which most likely means you're going to come down further. And again, I think that's why you need conviction in those pieces that you do have if you want to continue to buy, and maybe you stretch your timeline if possible. So again, it depends on your age and your situation as whether you should be doing that. And what we're talking about here isn't something I do for the clients per se. We stick to the basics with the clients, but and that seems to work quite well. It's just, again, just trying to answer the question from my own personal experience.